Hi, thank you for joining us today for our Precious Metals Royalty Conference. Investors are becoming more and more interested in royalties for three reasons. One, they want exposure to gold and silver. Two, they don't want the risks associated with an operating mine. And three, they want that free optionality associated with exploration that a mining company has to do to extend its mine life. Producing mines are always involved in exploration because they have to grow reserves to extend their mine life. And the best example of this is Franco-Nevada's Goldstrike royalty, which it bought in the 1980s. Franco-Nevada paid $2 million for that royalty, and that royalty has produced close to $1 billion in cash flow for both Franco-Nevada and its shareholders. So keep in mind today when you listen to our presenters that one of them might be sitting on another Goldstrike in their portfolio of royalties. And with that, I'm going to introduce you to our presenters now, beginning with Chris Mancini, our keynote speaker. Chris is a research analyst at Gabelli Asset Management, which is based in Rye, New York, and they manage over $30 billion in assets, $2 billion of which is allocated toward precious metals. Then we will hear from Dan O'Flaherty, the CEO of Maverix Metals. Maverix Metals has a portfolio of 121 royalties and streams, and 13 of those agreements are with producing mines. Recently, Maverix acquired 6 royalties from Pan American Silver, and Dan will provide an overview of those royalties as well as an update on Karora's Beta Hunt mine in Australia and Agnico's Hope Bay mine in Canada. Up next is Joseph de la Plante, the CIO of Nomad Royalty. Nomad has 15 royalty agreements, and 8 of those are cash flowing. Nomad recently acquired a royalty on the Caserones mine, which is located in Chile, and Nomad also issued a technical report on its largest asset, the Bloor mine, which is in South Africa, and Joseph will provide further details on both. Then we will hear from Nolan Watson, co-founder and CEO of Sandstorm Gold. Sandstorm has 229 royalties and streams, 29 of which are cash flowing. Sandstorm recently added a royalty and streaming agreement on the Vatukoula gold mine in Fiji and a royalty package on a portion of Vale's South American assets, and Nolan will provide an overview of these new additions. Then we will hear from Peter Grosskopf, CEO of Sprott Inc. Sprott is an asset manager focused on precious metals with over $17 billion in assets, and though Sprott is not a royalty company, it does provide many of the same benefits of a royalty company through its physical trust business, and we will discuss those benefits in detail with Peter. Up next is Shaun Usmar, the founder and CEO of Triple Flag Precious Metals. Triple Flag has a portfolio of 75 royalties and streams, 15 of which are in production. Triple Flag just IPO'd on the Toronto Stock Exchange earlier this year, so Shaun will provide an introduction to Triple Flag and its portfolio of assets. If you have any questions for any other presenting companies, send us an email to info@bloorstreetcapital.com, or you can mark your question in the open chat on the right-hand side of your screen. If you don't have time to watch this conference in its entirety, we will have a replay available on our YouTube channel, Bloor Street Capital. Be sure to subscribe to our channel and also hit the notification button so you can be kept up to date on future events. Once again, I want to thank you for your support, and I hope you enjoy the conference. Chris, thank you very much for joining us today for our Precious Metals Royalty Conference.
Yeah, thanks, Jimmy. Yeah, no problem. Thanks for having me.
Chris, before we hear your insights on royalties, why don't we just start with a brief overview of Gabelli and who started the company and also what your mandate is?
Sure. So Gabelli Asset Management is a publicly traded company on the New York Stock Exchange. It has around $33 billion under management. It's a value style investor. And the vast majority of those $33 billion are managed by a team that's led by the founder of the firm, Mario Gabelli. And it's again, value style investing. So Graham and Dodd, Warren Buffett, that kind of thing. Within that $33 billion, there's also around $2 billion, a little bit less than that, that's dedicated to precious metals mining. And I help manage those precious metals mining funds and separately managed accounts.
And 2020 was a very good year for precious metals, Chris. And 2021 thus far, not as good. Both gold and silver are down small. But how have the inflows been into your precious metals funds? Are they up or down year to date?
They're pretty muted. They're pretty flat year to date. Thankfully, I would have thought that they might have been, substantially down. I mean, they're marginally down this year. Last year, we had good flows in. So it really just depends. I mean, I was telling you a story before how we got a couple of weeks ago, we got like $8 million into the fund and we invested half of it. And then like a week after that, we got an $8 million outflow. So I think what the market's doing is it's interesting time now for gold. And I think that's, indicative of, in the flows in the fund where it's kind of like, there's some that are really bullish, some that are bearish, and we'll kind of see how it plays out.
Chris, I want to get a sense of how you allocate that $2 billion. Do you invest in producers, developers, explorcos, royalty companies?
Right. So we really invest. So here at Gabelli, what I do is, we invest across the spectrum. So all the way from the biggest, like a Nomad mining and royalty companies, all the way down to an exploration stage company. Very rare for us to take a stake in an exploration stage company that doesn't have a defined resource yet. So we want a defined resource. We're not geologists. We don't think that we can, go out and pick the guys who are really going to find gold. But once they've found the gold, we like companies that can have a proven track record of finding more and then delineating that into a resource and then either selling the project or developing it. So yeah, we really runs the spectrum, but we're more heavily weighted towards the bigger names.
And you mentioned that you and your team invest in royalty companies. And as you know, the sector, there are a lot of royalty companies out there. How do you and your team differentiate between them all? What sort of criteria do you use to make your investment decisions?
Yeah, I mean, what we're really looking for is like really great long life assets that can grow. So meaning, so we're looking for these real big kind of. So for example, we have a big position in Franco, Nevada, and they have one of their big royalties is on the Cobre Panama project, our mine, which is owned by First Quantum in Panama, and that is a mine that has an over 30-year life and has the potential to go much longer than 30 years. And an example that we were talking about, before with Franco is the Gold Strike mine, where when they bought it, it had, when they bought the royalty on the Gold Strike mine, maybe Gold Strike had 1 million ounces of resource or something like this, like maybe 30 years ago or something. And it's now the mine's been producing, it's produced millions and millions of ounces and has, a few million more left in it and maybe more on top of that. So, so we look for great quality assets. And then what we also look for is a management team that's able to really allocate capital well. And it's difficult to do in the royalty sector now because it is a relatively crowded space.
And how do you value royalty companies? Are you looking at earnings, cash flow, net asset value?
Looking at net asset value and then the free cash flow generation. So, at the end of the day, a company is what its value really is. It's discounted future cash flows. That's any company out there. That could be, Amazon or Google. That's how to value the company. So it's easier to do that, for a company that has a specific asset base that's depleting, like a mining company or a company that has royalties on mines. So that's the primary methodology that we use to value the companies. And then also from a free cash flow perspective, we're trying to figure out what the we're at, a company that might have a lot of net asset value because all of the cash flows coming in the future is worth less than a company that has the same amount of net asset value where the cash flows coming now. So we also look at free cash flow multiples for that reason.
And royalty companies tend to trade at a premium to their net asset value. Do you think they deserve to trade at a premium?
Well, I think they do until they deserve to trade at a premium until the producers can show that they deserve to, that they should take some of that premium away from the royalty companies. So meaning like the royalty companies trade at a premium because they haven't disappointed in the past like the producers have in terms of cost overruns and real huge variations, fluctuations in earnings year on year and quarter on quarter, having to borrow more money or to do dilutive equity deals. So because the royalty companies have been more stable, and less volatile, they trade at a premium, and so the producers are really going to have to prove that that they can do that too, in order to kind of take some of that premium away from the royalty companies and then have it go into the producing companies.
Now, Chris, you mentioned that you own Nomad, you also own Franco. Why would you invest in a royalty company over a producer?
Yeah, I mean, a company like Franco has shown in the past that it is like a gold mining investment for all seasons, really. And it's done very well on the upside, and it's done very well even on the downside, and for gold. And the reason is that it's a very well capitalized, very well known royalty company with a lot of resources. And so like on the downside, when gold goes down, there are a lot of companies that need capital, a lot of development stage companies, even production companies that had taken on too much, that had taken on too much debt. Well, so I say when gold goes down, how about when gold went down? Because we don't know what will happen in the future. But when gold went down the last time around in say 2012, the producing companies had taken on too much debt, and the development stage companies didn't have any access to capital. So the royalty companies came in, companies like Franco and Wheaton came in as the saviors, and they made a lot of money off of it. So so company like Franco and Wheaton can do really well on the downside, and on the upside, what happens is there are sometimes royalties in their library that just weren't, that weren't economic, or were royalties on mines that weren't economic. And then all of a sudden, because the price goes up, these royalties the projects become economic, and the royalties become worth a lot of money. So it has that good upside leverage too. So it's like, it's going to be, so that's why we have the royalties in the portfolio, is that they provide a good ballast in there, for the portfolio. It's something that's not going to swing too far on the upside or the downside.
Chris, as we wrap up, you work for a very large U.S. money manager, and you're exposed to a lot of information. And I want to get your sense on the gold and silver price, and also gold as an asset class. Do you think the price of gold is ever going to go up again? Is this a dying asset, or is there still a lot of interest in precious metals?
I don't think it's dying. I think that, even when people like, when that kind of commentary comes in terms of is it dying, we see how it trades relative to other assets on a daily basis, right? So it trades correlated with rates or correlated with the dollar. So there's just billions of dollars of volume traded in the futures market every day for gold. So it's an asset that's being used. now as a financial instrument within the within the broad kind of financial markets. That's not the same thing with something. Again, you didn't ask about Bitcoin, but I'll bring it up because people say it. Like Bitcoin isn't trading like that. It's trading just with huge speculation and all the trades on tweets from Elon Musk. You know what I mean? I mean, like gold trades with rates and commentary from the Fed, and Bitcoin trades with tweets from this this guy who seems like very smart, but I don't know how whether or not I'd be basing my investment decisions on what he says. So no, gold, will always, I think, it's the truth. At the end of the day, I mean, gold is the truth. You can't create another gold. God only put a certain amount of gold in the ground. So, I guess we're also not getting like a lot of people saying, oh yeah, gold's dead. I just took my gold money and put it into Bitcoin. We don't really see that happening either. So I don't think it's dying. I think that it is the ultimate hard asset. And people always want to hold on to something. They really do at the end of the day, right? You can even tell with COVID, like this year and a half of not being able to hold on to other people, I mean, has really, really damaged a lot of society, right? So I think that people want to hold on to something. That includes other people. I would love to shake your hand, Jimmy. I can't. And people also want to hold on to an asset, and that's gold. For what it's worth.
That's great. Listen, I want to thank you very much for sharing your insights on gold, precious metals, royalties, and also Bitcoin. Thanks
All
again,
right.
Chris.
Thanks, Jimmy.
Hi, Dan, and thank you for joining us today.
Good morning. Nice to see you.
Dan, I'm looking forward to this discussion. Before you became the CEO of Maverix Metals, you were an investment banker. So I want to hear your thoughts on consolidation within the royalty sector. But before we touch on that, why don't we just begin with a brief overview of Maverix Metals and also the history behind the company?
Certainly. Just as a high-level snapshot of Maverix Metals, we are a precious metals royalty and streaming company. Our market capitalization is approximately $750 million US. We've a portfolio of over 120 precious metals royalties and streams, 13 of which are paying and which generated over $50 million of revenue in 2020. So that's the high-level snapshot of the company. We've been in existence for 5 years, having spun out of Pan American Silver in 2016. With a then modest portfolio of 13 royalties and streams, 2 of which we're paying. So we've grown substantially in the 5 years since we launched the company.
And Dan, you have a very interesting management team and also board, and I want to touch on both of these. Your partner is Ryan McIntyre. He's the president of Maverix Metals, and before he was the president of Maverix, he was a portfolio manager at Tocqueville, responsible for the gold sector. And I'm curious how you and Ryan separate your responsibilities.
Well, just on the management and board as a whole, I'd say it's an extreme advantage that Maverix has, just the depth, and that really starts with our chairman, Jeff Burns. He was the CEO of Pan American Silver for 12 years, and stepping down from that role at the end of 2015 to the now CEO, Michael Steinman. But Jeff, in his capacity and being in the industry for that long, is a very deep technical Rolodex, very strong Rolodex, which attracted some very strong board members. He brought me in, as you mentioned, as a former investment banker, doing advisory work on a lot of precious metals, royalties, and streaming M&A side on the advisory side. Ryan McIntyre joined us as president out of Tocqueville, having been there for 12 years on the buy side, and brings a very unique vantage point of having seen what investors are looking for, particularly what they're not looking for in investments, having been on that side of the business. So it's been very complementary with the technical depth, the buy side depth, the market depth, as well as the M&A depth in terms of the team. It's been highly complementary.
Dan, I want to touch on your board now. You have representation from Newmont and also Pan American Silver. And I'm sure these people bring a lot of insights and a lot of intel to the board, and you can tap into them on a regular basis. Do you speak to these individuals often outside of the board meetings?
Absolutely. We have a tremendous relationship with Pan American, who has representation on our board, with Newmont, who's representation on our board, and Kinross, we actually have a director in common with as well. So it's been very advantageous to Maverix to have these relationships. They're all stakeholders in the company. Newmont is a 30% shareholder. Pan American Silver is at 18%. Kinross is at around 8% as well. So they truly are, equity investors and kind of invested in the long-term success of the business. But it's been beneficial to us just from one, a relationship standpoint, being able to be introduced to many of their contacts that they have across the industry. Two, from a due diligence perspective, there aren't many assets in the Americas that executives and engineers and technical people from each of these teams at Newmont and Pan American and Kinross haven't looked at. So that's a unique benefit that Maverix has when we're kind of doing due diligence, as well as deal flow as well. We've done an initial transaction with Pan American Silver in 2016. We recently acquired another portfolio of royalties from Pan American Silver earlier this year. And Newmont, we acquired a significant portfolio in 2018 of 51 royalties. And just in the second half of 2020, we acquired another 10 plus royalties from Newmont in the royalties, precious metal royalty business. So it's been a very great relationship for Maverix, as well as for the shareholders who have benefited from holding Maverix shares as we've grown the business.
And Dan, I'm glad you brought up the fact that they're also significant shareholders in Maverix Metals. Is this something you'd like to change in the future? Would you like to reduce their positions and bring in more institutional investors?
I think it's a balance. It's tremendous having these major mining institutions on our registry, but we'd also like to continue growing the float and grow the capital markets profile. And we have been doing that, as evidenced by the significant growth in volume. One step we did was listing on the New York Stock Exchange, which has dramatically increased our volume. Most recently, we were added to the GDXJ, where we saw that index inclusion brings more investors. So it is a benefit to growing that institutional shareholder base, growing that retail shareholder base, growing the volume, as well as kind of maintaining a long-term core of very supportive shareholders.
Dan, one other question on Newmont before we move on, but I just would have assumed Newmont would have sold all their royalties when they spun out Franco-Nevada many years ago. Why are they still selling or getting rid of royalties?
That's a good question, and we get that question a lot in the context of, are there any other royalty portfolios out there? How does this work? Aren't these royalties are all gone? And the reality is Newmont did spin out their royalty portfolio to Franco-Nevada over a decade ago, tremendously successful, obviously. But the royalties that we acquired in 2018, those were the royalties that Newmont had created since then. Organically, whether it's through joint ventures, through mergers and acquisitions, through land transactions, and that's the royalties that they had created since the Franco-Nevada spin out in the 2000s. And the recent transaction we did with Newmont in late 2020, that portfolio was a royalty portfolio that they acquired through their acquisition of Goldcorp. So there's a constant creation of new royalties, which is great for us in the business of acquiring royalties and streams, seeing them be kind of constantly created throughout the mining industry.
Dan, that's a great overview of Maverix. Now I want to spend some time on what you and your team look for exactly when you evaluate new royalties. And why don't we just begin with deal size? What's your minimum deal size that you would do, and what's your maximum that you can do?
Well, I would say I'll start with the sweet spot of the transaction that we're looking at are generally in the $50 to $100 million transaction range. We are looking at some that are larger than that and some that are smaller than that. It is a balance of what's very meaningful to Maverix and where we can generate a very attractive return. But we're looking across the spectrum at deal size. But that's a broad overview. In terms of what we're specifically looking for, right now our portfolio is 99% gold and silver. So we're very much a precious metals royalty and streaming company. We're looking for good underlying assets. It ultimately comes down to the resource at the end of the day. So that's incredibly important, not to be understated. Just the underlying asset itself. As well, jurisdictions. Right now, over 80% of our revenues comes from Canada, the United States, Australia, and Mexico. So industry geographies where mining has been, long understood, and where there's a very strong rule of law, and we tend to favor these mining jurisdictions as we look at new acquisitions as well. The counterparty is very important as well. We like to see good operators. Strong ESG is becoming very important, generally in the mining sector, which is fantastic. That's something we absolutely look for, in our investments. One thing we're also is it's a very straightforward business model. It's royalties and streaming. We're not looking to kind of go into direct mining investments whatsoever. That's not our interest. In terms of the metal mix, we are precious metals focused, as I mentioned. So it's a very straightforward portfolio, both on the royalty and the streaming side of the business.
So as you mentioned, your portfolio is 99% gold and silver, but would you entertain going into other metals or adding other commodities to the portfolio mix?
I'd have to say our focus is always going to be gold and silver. Just given how much we have right now, we do have a little bit of room to add other metals, but it's certainly out of focus. And we're certainly not going into say oil and gas or battery metals or whatnot. But yeah, I would say it's precious metals, but we do have a little bit of room in the portfolio if there's something very high quality and opportunistic. But again, we are kind of a gold and silver focused royalty model.
And Dan, what percent of your portfolio is made up of streamers, and what percent would be royalties? And is there a certain mix that you're trying to achieve?
That's an interesting question. Our portfolio is predominantly royalties, particularly by number of assets, particularly by where the growth in the portfolio is. A little bit is the history as to how Maverix has grown. We've grown through a number of portfolio acquisitions, as we mentioned, 2 from Pan American Silver, 2 from Nomad, a portfolio acquisition from Kinross, and a portfolio acquisition from Gold Fields as well, where each of those was comprised entirely of royalties, precious metals. We've also augmented that royalty business with a number of individual streaming transactions. So I'd say that we have both the ability to acquire pre-existing royalties, creating royalties, as well as creating new streams. So really it is a balance and situation specific in terms of whether it's a security angle or a tax angle. But at the end of the day, where Maverix is looking to do is keep it very simple and easy to understand. So even in the streams that we do have, there's no buybacks or complicated kind of structures. It is very much we have on our royalties and streams, no material buybacks, no caps, and that's what we think our investors are looking for exposure for.
So even someone like myself can make sense of it.
Well, it's a good business model. We try not to complicate it too much.
So Dan, let's move on to your portfolio of assets. And you recently purchased 6 royalties from Pan American Silver, and I'm sure there's one or two in there that you were very interested in. Why don't we touch on these new additions?
Yeah. No, I think, and I'll say this for both the recent acquisition from Pan American Silver as well as the recent acquisition from Newmont as well, is it really bolstered our already strong development portfolio of royalties. What they have in common is they're all precious metal royalties. They're all in the Americas corridor at various stages of the exploration and development curve. Specifically for the Pan American portfolio, royalty on the Fenn-Gib project in Canada, operated by Mayfair. It does have an indicated resource of over 2 million ounces of gold. Early stages there, but it looks very exciting. Recuperada recently put into ramp-up production in Peru. A very strong silver resource there with great potential. Juby as well, another asset that we have an NSR on, acquired through the recent Pan American transaction, operated by Eris Gold with indicated resources of around 800,000 ounces with another inferred resource of 1.5 million ounces. So, those are some of the attractive ones in the Pan American acquisition and that portfolio. The Newmont transaction was very exciting for us as well, where we had some very near-term producing royalties coming on with Camino Rojo, a royalty there, where Orla has done a tremendous job advancing that through the construction phase. So that's going to be contributing to our revenue over the next 12 months, and they've done a great job there. Bluestone Resources has done a great job at their Caballo Blanco project. They recently rescoped that project, so it's a much larger potential operation. So we're very excited about the the additions to the near-term, mid-term, and exploration stage portfolio that we acquired through the Newmont and Pan American recent acquisitions.
That's a great overview. I want to spend a little bit of time now on some of your more significant producers, one of which is Beta Hunt Mine, which is owned by Karora Resources. It represents approximately 15% of your NAV. And they just announced that they're going to double their gold production effectively, going from 100,000 ounces to 200,000 ounces by 2024. Why don't we just talk about this and what exactly that means to Maverix by doubling the production?
Certainly, Beta Hunt's been a very interesting one, royalty asset for Maverix to follow. Going back to when Karora was branded as RNC Minerals, they were struggling a little bit with their financial situation. They ended up having a tremendous discovery with the Father's Day vein a couple years ago now, which really turned the fortunes for the company. They were able to bring in new leadership, rebrand the company as Karora. They've done a tremendous job growing both the asset base as well as the financial capability. They've been doing an excellent job with the exploration and now expansion that's in the works. We couldn't be more pleased with the process that they're making at Beta Hunt. And in terms of incremental production, it is going to be very meaningful to us in terms of near-term incremental gold equivalent ounce production to Maverix.
And one of the features that I'm really trying to stress in this conference is that the mining companies, when they do double their production, like Karora Resources is doing, they're going to spend about $120 million doing that. But you, as the royalty holder, you don't have to put up one penny, and yet you're going to reap a lot of benefits from this.
It's it's a really interesting time in the mining industry right now, where we've seen the gold price be relatively stable above 1,700 over the past few years, and at these kind of sustained higher gold prices, we're seeing the underlying operators investing significant capital in their own assets for the benefit of their own shareholders, and the royalty companies are getting that benefit as well, as you mentioned, at no incremental cost. So it's a very exciting time for across the royalty spectrum, not just Maverix, but for Maverix, we've got a portfolio of 121 precious metals, royalties, and streams, only 13 of which of those are paying. So it's approximately 90 assets that are at various stages of being moved forward. And at these gold prices, we are seeing significant investment, whether it's operators expanding existing operations like Beta Hunt, whether it's new operations coming into production with Camino Rojo, where we have a royalty on. But, we're really seeing some exciting investment in the industry as well. And it's not just whether it's investing dollars directly in projects, it's mergers and acquisitions as well. We have a royalty on Corvus's Mother Lode project. Anglo Gold just announced a potential acquisition of that project. That would be very exciting, for Maverix to see that project, go into a very deep-pocketed, strong, mining operator that's looking at some potential regional consolidation there. So it's exciting, an exciting time to be kind of in the royalty sector here.
So I want to touch on Corvus Gold, but before I do, let me first bring up Agnico's Hope Bay mine. Yeah. And they exercised a buyback, $50 million buyback. So why don't we just begin by getting your thoughts on that? Why did they exercise that buyback, and what exactly do you have on this asset and what it means for Maverix?
Certainly. So it was a partial buyback where our royalty of 2.5% on Hope Bay got reduced to 1% NSR, which we still retain, plus $50 million in cash. And this is a very I think win-win transaction where we see Agnico, the natural operator of this tremendous project, in terms of the most experienced in the region in northern Canada. They have a very long time horizon where we expect them to put significant capital. While we were disappointed to see the royalty drop from 2.5% to 1%, that retained 1%. It has a much brighter outlook over the next 20 years, which is the current mine life. We're seeing Agnico spend money looking at studies to expand it. They did exercise that partial buyback for $50 million. So they, just based on that, they're committed to seeing, I think, a lot bigger and longer term operation there. But, in terms of what that did to our balance sheet, very much strengthened our balance sheet. We now have $50 million in cash, no debt, credit facility right now available to us of $120 million. And we do retain that 1% NSR on Hope Bay going forward.
And they also announced they're going to spend $16 million this season doing some drilling, I believe 69,000 meters. So once again, potential upside and no cost to you as the royalty holder.
No, absolutely, and I think that it's that embedded optionality that really is something that all the royalty companies benefit from. Is, you know, it's a free option on exploration, a free option on mine expansion, on you know, new project development, and these are options that don't expire and don't have any holding costs. And that's the portfolio model that I think is very attractive to investors, which is why we've seen a lot of focus on, you know, on the royalty sector. And that actually, that investor demand and that you know, appeal of the royalty model to investors, I think, has driven some of the new entrants that we've seen come into the precious metals royalty and streaming sector. Just, you know, driven by both demand on the investor side as well as opportunities to deploy capital. There's a lot of opportunities out there right now that we're looking at, Jimmy.
Dan, I want to move on to the development side of the portfolio, and you already touched on Corvus Gold, but I just want to get your thoughts on this. And as you mentioned, Anglo Gold, they already own 20% of it, and they made a bid for the rest of the company. They're paying $4. The deal's been trading above that since the deal was announced, so the market's basically saying that they're going to have to pay up to buy this. But what is it about this asset that intrigues Anglo Gold?
Well, again, we can't speak for Anglo Gold, but looking at it from our perspective, I think it's got to be scale. You're looking at a tremendous scale for a company the size of Anglo Gold. That's what they would require. We're looking at a great jurisdiction, you know, a tremendous mining history, and I think there's you know, a huge potential there. You know, we're seeing, you know, a lot of in that kind of very tight zip code getting a lot of attention. So, you know, Anglo and obviously has announced their intentions with Corvus. So, you know, we're watching that and, you know, applaud what Corvus has done to advance the asset to get to this stage.
In 2021, you've been relatively quiet. You just announced the Pan American deal, but that was relatively small. Is this because you can't find any royalties or streams that fit your internal rate of return, or any royalties that fit your profile? Or is it just quiet overall?
Actually, I wouldn't translate kind of the announced transactions to the overall busyness of the sector, because I would say we're as busy now as we've ever been. And talking to our peers and colleagues in the precious metal royalty sector, they're equally as busy. So I think we'll see a lot of activity in the second half of 2021 here, because there are a lot of opportunities, whether it's pre-existing royalties that are now being marketed, whether it's operators that are looking to expand projects or build new projects. You know, there's certainly you're seeing an interesting time in the capital markets where the gold prices has been, you know, at a sustained level of above 1,700 for a few years now. So projects have looked better than they did 5 years ago economically. People are excited, they want to do deals, but we're not seeing a wide open equity window in terms of, you know, just unlimited capital available to every single operator. So we are seeing a lot of opportunities for a royalty or stream to fit into the capital structure of a business that's being built. So we're seeing a lot of opportunities, and I think we'll see a lot of transactions across the royalty sector in the last half of this year.
Dan, as I mentioned on the onset, you were an investment banker before you became the CEO of Maverix Metals. So I want to hear your thoughts on consolidation. Recently, we saw Gold Royalty make a bid for Elite Gold Royalties, about a $200 million deal. But do you think this is the beginning of further consolidation within the royalty sector?
That's an interesting question. Historically speaking, when we've looked at mergers and acquisitions in the royalty sector, there have been a number of transactions, and it's typically been cyclical, where we've seen where there haven't been a lot of opportunities to directly deploy capital. That's when, historically speaking, the royalty companies would look at each other for avenues of growth. And right now, we're seeing a lot of opportunities to directly deploy. Ultimately, you know, I think that it potentially may change, and we'll see consolidation. You know, we did see that the Gold Royalty NEV transaction, but I think it's interesting to mention where Maverix sits in kind of the royalty universe on the precious metal side. You know, I think we have a pretty unique advantage, you know, where we differentiate ourselves from, you know, the Franco-Nevadas and the Wheaton Precious and Royal Gold, the industry leaders, in terms of I guess, a couple parts. One is valuation. We trade a substantial valuation discount, whether that's due to size, liquidity, and we see this as a huge opportunity for us to be able to kind of grow where our valuation multiple is. And two is that ability to grow. We're seeing transactions that are absolutely move the needle for Maverix, but won't necessarily get some of the larger players in the sector excited. And well, this may be a silly anecdote, but it is easier to grow a $500 million company or $750 million company than it is a $10 billion company, so to speak, on a percentage basis. So it's the ability to grow and ability to grow our valuation as well. So I see a huge opportunity for Maverix, and where we differentiate ourselves from a lot of the newer entrants to the business is really the existing cash flow portfolio that we have. We did generate over $50 million of revenue in 2020, very high margins, approximately 90%. So a significant cash flow engine, a significant growth pipeline that's already existing, whether it's near term, midterm, or development or early stage exploration. We have significant exposure across that spectrum, and access to capital. And we've got $50 million in terms of cash on the balance sheet. We've got access to another $120 million credit facility, so we can write checks, we can compete. We've got an existing base. So in terms of the market cap of $500 million to $1 billion in the precious metal royalty and streaming sector, we're actually, I believe, the only company right now in that size range. So it does give us some opportunities. So you mentioned it is a crowded sector. It can be crowded at certain parts of the size ranges, but where we're seeing a lot of opportunities, both to grow the valuation and to grow the portfolio.
Dan, as we wrap up, what can investors expect in terms of news flow in the coming weeks and months from Maverix Metals?
Well, I think it'd be twofold. As I've mentioned a few times, we are seeing significant investment in underlying assets that we already have royalties. So we'll continue to see that. And, we can't predict when exactly the operators are going to put out their news, but, we do expect some positive developments on that front. And, as I mentioned, we are looking at a number of opportunities to continue to grow the portfolio through acquisitions. So, it's impossible to promise exactly when those will be nailed down, but we are working on a number of different opportunities. And I think it's just really, it's just more of the same is what I'd like to say is, we've grown this portfolio from an initial portfolio of 13 royalties and streams, 2 of which are banked, where we are today with 121 royalties and streams, 13 of which are banked. Substantial growth year over year, not just on an absolute basis, but on a per share basis. We've grown revenue per share, gold equivalent ounce production per share, net asset value per share, and insiders do own 8% of the business, and we do think of ourselves as owners and growing those per share metrics. So I think just going forward, it's just more of the same, continued growth in the precious metals royalty and streaming business, and that's where we see a long path to continue forward. We're excited about it.
Well, you've come a long way in a short period of time, and I want to thank you for sharing the Maverix Metals story with us today. To all the viewers, if you have any further questions for Dan or another member of his team, please send us an email to info@bloorstreetcapital.com, and we'll make sure you get a response to your questions. Or if you would like some research on Maverix Metals, send us an email and we'll send it along. Once again, Dan, thank you.
Thank you for having me on. Appreciate the time.
Joseph, thank you for joining us today.
Thanks, Jimmy. Thanks for having me.
Joseph, before we do a deep dive on your portfolio of royalties, why don't we start with a brief overview and history of Nomad?
For sure. So Nomad, we're one of the newest royalty companies to have entered the space. We listed in May of 2020, so just over a year ago. And since that time, we've been hitting the ground running. Nomad is a venture that I started with my 2 partners, Vincent Metcalf and Elif Levesque. The 3 of us have been working together for the better part of the past 7 years directly in the royalty space. So we're a team with a lot of experience in this sector. And the impetus for starting Nomad is we think there's a huge opportunity still in the royalty space, and particularly in terms of building a cash flowing business. And so we saw an opportunity to enter the market with a set of assets that would get us on the map with a great amount of cash flow. And we've taken that and we've built on it since our listing just over a year ago. So we started with 9 assets in the portfolio. We're at 15 assets today. So we've done 6 acquisitions. In our first year of operations, we generated $30 million of revenue at a 90% cash margin. So, when you look at Nomad versus the rest of the space, a very considerable amount of cash flow for a new company. And essentially, we've hit the ground running in terms of building out our platform and positioning us in the royalty space in order to be able to compete. So in our first year of operations, we got the listing done. We got a $75 million credit facility, which essentially acts as our war chest to go out and make new acquisitions. We've initiated a very significant dividend policy, made 6 acquisitions. And so from where we stand today, in our point of view, a very mature royalty platform ready to execute on an aggressive growth strategy, replicating some of the very successful track records we've seen in the royalty space over the last 10 years. And the objective for Nomad is to build that next senior royalty company. That is very clearly what we're setting out to do. We think that we have a very good positioning in the space to achieve that, given our size, given our financial capacity, and given our team's track record and experience in the space.
Joseph, you mentioned that you have 15 assets in your portfolio. How many of those are producing or cash flowing?
So we have 8 assets that are cash flowing currently. And that's what really differentiates our portfolio from some of the other intermediate and junior royalty companies out there. So those 8 assets represent currently about 65% of our total NAV. And we have 2 assets coming online, one currently, Bloor. We also have Woodlawn that we expect to see a restart, which would take us to about 75% of our net asset value from assets that are producing. So it's a unique portfolio for a new company to have. And again, it's part of our strategy to continue down this path of adding assets that are cash flowing or near cash flowing, because in our view, that's what generates the highest multiples in the space, is that low volatility cash flow from royalties and streams.
And what's a typical deal size? What would be your sweet spot?
So, for the size of our company, we're obviously mindful that we're not looking to add assets that are huge within our portfolio. We really like diversification. And so from that point of view, the $25 million to $100 million deal size is really within our sweet spot. And within that, it can be anything. We can be looking at portfolios. We can be looking at existing royalties that are for sale. And really, one of the key areas that we're focused on right now, just given some of the returns or the return dynamics that we're seeing in the space, is streaming and originating new streams. So that's something that our team is well versed in. We've structured many streams as part of more complex project financings in the past. And right now we're seeing a lot of opportunity within that transaction type. So that's something that before the end of the year, we're hoping to have news in terms of adding new assets to the portfolio. But again, we're not looking for huge anchor assets to add to the portfolio. It's really taking measured steps to grow the portfolio, add diversification in terms of new revenue streams, but also new jurisdictions, new operators. And ultimately, that's our philosophy is, we're not operating these assets. And so it's important to have a good amount of diversification, because even the best jurisdictions or the best operators will have a bad quarter. So it's really important, to diversify as much as possible. And we think with that strategy, it gives us a huge amount of opportunities and a huge amount of deal flow, because the royalty model is evolving and the stream model is becoming more prevalent. And we're seeing more operators looking for this form of capital as they structure their project financing.
That's a great overview of Nomad, Joseph, but why don't we do a deep dive now on some of your assets. Your flagship asset is Bloor, which is a gold mine in South Africa, and you just came out with a technical report on that mine, which revealed a lot of very positive economics. But that mine's been in production for quite some time, and then it was offline for a while. It just started up again. Why don't we just start with a brief overview of Bloor and the history behind it, and then we can dive into the technical report and the highlights.
Absolutely. So Bloor is a very significant asset within the context of the Wits Basin in South Africa. For those of you that don't know this area, it's the home to many major mines. Within a 20-kilometer radius, there are 6 mines that have been producing for some of them, before the 1950s. So it's a very big mineral endowment, and essentially many different mines mining the same reef. Okay, so within that context, Bloor has been a very significant producer, not just within this area, but globally. The mine that produced for 50 years, it produced 38 million ounces. During many years of its history, Bloor was the single mine in the world with the highest level of gold production. So it's a mine that's well known, that's well understood. There's not much about this operation that we don't already know, just given that long history. And did shut down in 2011, and changed hands within a private group that has been looking to restart it since then. And we've now come to a point where that new redevelopment is occurring. The mine was built essentially prior and during the global pandemic, and has now begun to produce its first gold and make their deliveries to Nomad. And from our point of view, this is an asset that we've had in the portfolio since day one. We did our listing with Bloor, within our portfolio, but it's owned by a private company, and that means that they don't have any public disclosure around, the mineral endowment or what their plans are for this mine. So up until this point, there's been little amount of information in the market for our investors in terms of what this mine can produce, and we've been trying to give our best guidance to investors in terms of what it is and what it can do. But essentially, over the last 2 months, on June 28th to be specific, we put out a technical report going into a lot of detail around the mine's history, the mine's future, the mineral endowment, and now investors can really understand what this mine is and what it represents. And that technical report essentially outlines a 22-year mine life based on this initial reserve that they've outlined. It's 5.5 million ounces of reserves, but importantly, a 22 million ounce resource. Okay, so again, a very significant deposit, and also a very profitable deposit. So it's, this mine is going to produce on average 240,000 ounces a year once it's fully up and running, and that's going to take a couple of years of ramp up to get up to that run rate. But it will produce at an all-in sustaining cost of $570 an ounce, which from a global point of view is a very competitive cost point and very profitable. Nomad, we are the only creditor to this company, so they've built all of this with their own equity. So it's a very favorable situation here for the operators, who are going to enjoy a huge amount of cash flow from this operation, but also from our point of view as a streamer, we have a 10% gold stream on this mine. So the deliveries, once the mine is up and running, are going to be very substantial and will quickly become a bigger and bigger component of our revenue stream. So it's obviously an asset that we like a lot. We've liked it from day one since we went to see it during the due diligence process before we acquired the portfolio from Orion. But it's rare to see royalties and streams on assets like this. And so, we think that this is a tier 1 asset, not just within our portfolio, within the industry. And, as the mine ramps up and as the market gets to see the deliveries that we're getting within our portfolio and build the confidence around that, we think that we'll, see a lot of value coming into our share price for this operation.
So as you said, it is producing gold, but it is going through a ramp up stage. When will it be at full production or at nameplate capacity?
So there's essentially 2 stages to this ramp up. The operator likes to think about it in terms of tons per month. So before the end of 2021, they're targeting 20,000 tons per month, and then subsequently a ramp up to 40,000 tons per month during the course of 2022. And at that point, what happens is they're going to use some of the cash flow that they're generating to add a second line within the mill. There's actually going to be an expansion and double the capacity up to 80,000 tons per month. And so they've built that, that expansion and ramp up within their within that technical report, within that life of mine plan. So that's why we see the deliveries over the next year increasing gradually as the operation builds steam, and as they open more and more stopes underground, we will see more of that gold coming to us.
So Joseph, one of the things that's unique about Bloor is also the mining method. Maybe you can touch on that.
Yeah, absolutely, because it's a little bit different, not too different. So reefs in South Africa have typically been mined through, I guess, what we call conventional stoping. Because these are flat-lying ore bodies or quasi-flat-lying ore bodies, they have to mine them essentially by, or they historically mine them by mining a height of 120 centimeters and diluting that high-grade ore that's within the reef and sending all of that to the mill. The new plan here at Bloor is to implement what's referred to as residue mining, or also known as split blast mining. And this is not a new mining method. It's a mining method that's used in other parts of the world very successfully. It's new to South Africa and to this specific part of South Africa, primarily as a result of the fact that historically, even though operators have wanted to implement it, they've had challenges with unions who've opposed essentially this change in methodology that results in a leaner operation with fewer employees underground. So the interesting dynamic here is that because Bloor is restarting, it's a brand new workforce, a brand new union, and they're able to implement this for the first time in these reefs in South Africa. But the mining method, again, it's a simple one. They're essentially, rather than blasting a full height, that 120 centimeter full height, they're going in and they're doing two blasts. They're blasting the waste first, getting the waste out of the way, and then doing a second blast to mine only the reef ore. Okay, and so that allows them essentially to manipulate a much smaller amount of tons and bring just these higher grade tons up to surface and through the mill. And so that's where you realize some significant cost savings because of this mining method. And also important to recognize that they haven't just gone out and said, well, we're assuming 100% of this mine is going to be mined with this mining method on day one. It's built into the plan. We're starting with the traditional mining. They're opening up new areas. And as they gain the productivity underground, they're implementing split blast mining gradually into the process. And again, building that expertise on a small level underground and then on a bigger level as the mine gains steam. But again, it's not a new mining method, and it's something that's implemented very successfully in other operations throughout the world.
And I'm curious, when you say fewer underground miners, what kind of reductions do you have in terms of employees because of this new mining method?
Well, if you look historically, I mean, Bloor at its full run rate was an operation that could have employed up to 4,000 people. We're looking now at something, once they hit full capacity, about 1,000 employees. So it's a fairly substantial reduction. And I think, to a large extent, that's why there's been some difficulties with some of these deeper underground mines in South Africa, just because the significance of that labor force. So with this new mining method and with this new context, it provides a very new, essentially, context for old mines and a new look or a new outlook on some of these older mines. And Bloor also is important to understand, it's not as deep as a lot of the other mines in the area. We're talking about 1.82 kilometers versus some that are substantially deeper. So it's a really good context to be trying these new mining methods and taking this new outlook on these older mines.
Joseph, that was a great overview of Bloor. Let's move on. Last month, you also announced the purchase of a royalty agreement on the Caserones mine, which is copper in Chile. Why don't you give us a brief overview of that?
Yeah, so we're very pleased to announce that acquisition. It's a deal that had been in the works essentially since before Christmas. And it was a royalty that we acquired from Appian, who had been running a sale process on a royalty portfolio. This was a much smaller component of the portfolio. And we liked this royalty from day one when we saw it. We wanted to buy just that one. It took a few months to get there. But we're able to reach an agreement to acquire it for $23 million in probably the most favorable copper environment that we've seen in a long time. And the fortunate thing is we priced the deal before Christmas at a much lower copper price, so we thought that we got a good deal on this one. And essentially, it's a 0.28% NSR on a major mine. It's operated by JX Nippon. It's a subsidiary of a large Japanese conglomerate. It's a mine that's very strategic to them because they also own the smelter where the concentrate is headed. So a lot of incentive to keep this mine running for a very long time. Right now, it has a 17-year mine life based on the current reserves. We think that can go substantially longer. And as evidence of that, they've invested $4.2 billion building this mine. All right, so it just shows the dedication of the operator here. And from our point of view, there's never been a better time to invest in copper. I think there's very strong fundamentals for the copper price over the next few years. We've seen obviously a good run here, but a lot of very sophisticated mines calling for much higher copper prices from here on out. So again, a long mine life, cash flowing royalty in a good jurisdiction with an operator who's highly incentivized to keep it running. And on top of that, 17,000 hectare land package associated to the royalty. Okay, and we're talking about the region of Atacama, Chile, where we've seen some very substantial discoveries, even just this year with Filo del Sol from Filo Mining. So within this context, I think there's a lot of very positive things at this operation, and having a royalty, even a small one on an operation like this, is something that fits very well in the portfolio. The copper angle is new for us. Up until now, we've been 100% precious metal focused. This brings our NAV from copper to about just under 5%. So a very manageable part of our portfolio. We'll never go, a huge amount of our portfolio associated with copper, but these smaller measured bets on copper, I think, fit really well, especially on cash flowing mines. So for us, these types of acquisitions, when we come across them, we'll do them any day of the week.
Joseph, there's one other asset in your portfolio I want to ask you about before we wrap it up, and that's the Robertson property, which is owned by Barrick. And Barrick just featured it recently in their analyst day. Can you give us an overview of that asset, please?
Yeah, Robertson is a royalty that we acquired last year when we acquired Coral Gold. So as part of our growth strategy, we're looking at all types of deals, but M&A certainly fits within that. And Coral was the first M&A deal that we did. And Coral owned basically cash and this royalty. And Robertson, it's important to understand what it is. It's a piece of property that forms part of Cortez. And Cortez is a very significant gold mine owned by Nevada Gold Mines, operated by Barrick, owned by Barrick and Newmont. And it's a mine that produces 800 to 1.2 million ounces given the year, so a very substantial level of production and very substantial infrastructure. They have basically any type of ore can be treated within the infrastructure within the Cortez camp. And what we're seeing at Robertson is essentially transitioning away from the existing deposits within the Cortez camp to Robertson over the next few years. And so they've outlined at the analyst day what that plan looks like. We're talking about production that's going to commence in late 2024. They're referring to it currently as a tier 2 mine. So what does that mean? That means for Barrick, tier 2 means 250,000 ounces a year for 10 years. But we think, truthfully, this is an emerging tier 2. It could even become a tier 1. And the reason we think that is because at Robertson, there's currently just an oxide resource at surface. And that's what is feeding this near-term life of mine plan. There was a resource there that had been identified by Coral. Barrick, since they acquired the property, had been drilling it. They've come out with this plan now. There's a pre-feasibility study in the works. So they're really committing to this near-term production profile. But what's exciting about Robertson is that separate from this surface oxide, there's a whole other resource potential at depth in what's referred to as the lower plate mineralization. And this lower plate setting is what gives rise to deposits like Gold Rush and 4 Mile and some of the much bigger deposits that we see in that Nevada camp. And when you listen to this analyst day and when you see some of the information that's come out from Barrick, what's becoming clear is that Nevada is becoming a core focus again for the company. And within Nevada, this corridor from Robertson to Pipeline is going to be one of the focuses in terms of exploring this lower plate mineralization. So from our point of view as a royalty holder on this ground, we get the best of both worlds. We get near-term production. We get the best operator in the world committing a huge amount of capital and resources and time and energy to drilling and new discoveries. So everything that we had liked about this royalty when we bought it is materializing quicker than we had hoped. And it's the perfect setting to own a royalty. And we truly think that this royalty is going to have significant news flow, major milestones over the next few years. So we're very excited about it. We think it can become, within our portfolio, a major royalty, and within the royalty space, probably one of the more valuable gold royalties out there. And if you had to, put a producing royalty on a Cortez mine operated by Barrick out there right now, and tell all the royalty companies to bid on it, you'd probably see some pretty high prices. So that's what we think it can generate for our own share price over the next few years.
So I was going to ask you if there was one asset in your portfolio that you were most excited about. I guess this is it.
Well, it's rare to find a royalty that gives you that mix of the safety of that near-term production, but also that lottery ticket type exploration potential. And when you find a royalty like that, you buy it, and that's what we're able to do. And we're very excited about the future there.
Joseph, you currently trade on the OTC in the US. Do you have any plans on uplisting?
Yes, we do. So we launched on the TSX in May of 2020. For many reasons, we delayed the US listing, as a result of wanting to keep our G&A low for the first couple of years of operation as we built out the business and the investor base. But listing in the US is something that very clearly we want to do, and we're taking steps towards that. We haven't announced a US listing yet, but we expect our current OTC listing to be uplisted to the New York Stock Exchange, hopefully over the next 12 months, and we'll be releasing news to the market on that front. But we've been taking steps to prepare the company in that direction, including the recent share consolidation, which was all done to prepare the ground for that listing.
And Joseph, what can investors expect in terms of news flow in the coming weeks and months?
Well, the great thing about a royalty company is there's many different types of catalysts that you can see, a lot within our own portfolio. Certainly ongoing developments of the Bloor ramp up, exploration results coming out of Robertson, more developments on the actual operation of the Robertson mine. We have great royalties like a royalty on the Troilus deposit, which is advancing rapidly, Blackwater. So that organic growth, I think, is something that you're going to see deliver a lot of value and a lot of news flow over the next year or 2 years. But in addition to that, the exciting thing about a royalty company is we have $80 million of financial capacity that we're actively looking to deploy as well. So new deals, new streams that come in and build out the portfolio. I think that's a very exciting part of the royalty business, and one where we're seeing tremendous amount of growth right now. And for ourselves as a $500 million market cap company, that $80 million financial capacity means that we can have a big impact on our business by doing new deals. So I think that's something that shareholders should look out for. I can certainly tell you that we were busy, and we've been busy since day one, and we're not taking the summer off. So we hope to have news for the market over the next few months.
Well, that's a great overview, Joseph, and I want to thank you for spending time with us today. If any of our viewers have any other questions for Joseph, or if you would like some research on Nomad, please send us an email to info@bloorstreetcapital.com. Once again, Joseph, thank you.
Thanks, Jimmy.
Hi, Nolan. Thank you very much for joining us today.
Oh, thanks for having me. I appreciate it.
Nolan, Sandstorm recently announced the addition of a new streaming agreement and also the purchase of a package of royalties. And I want to touch on these new additions to your portfolio in more detail. But before we do that, why don't we just start with a brief overview of Sandstorm and also the history behind the company?
Yeah, Sandstorm is a royalty and streaming company, kind of like a miniature version of Franco-Nevada or Wheaton River or Royal Gold. And we've been around for just over 10 years now as a company started by myself and a guy named David Oram. And we've been growing it methodically over the years. And I think we've got about 229, so just shy of 230 streams and royalties that we've accumulated. Just about 30 of those are in production and producing cash flow already. And so we've got a wide portfolio that we built over the years. It's diversified in terms of where we're getting the cash flow. We're focused on precious metals, so over 80% of our production is gold and silver. And what we're trying to do is just continue to do what we've done year after year for 10 years and just keep growing the company. And these transactions that we just announced are for that purpose.
So why don't we start there, and we'll begin with the new asset you purchased, Vatukoula, on the new stream you purchased on the Vatukoula gold mine, which is in Fiji. And I have to be honest, Nolan, I didn't even realize Fiji had a mining industry, but that mine's been in production for many years. So why don't we just start with a basic history of that mine, and then we can dive into the details behind the streaming agreement.
Yeah, one of the types of things that we love at Sandstorm is lots of exploration upside. We think that that's where we get a rate of return for our shareholders that is where it becomes superior to some of our competitors. So we really do focus on that exploration upside. And the reason that we did this deal and this asset, Vatukoula in Fiji, is because it's one of those assets that's had a reserve life of 6 or 7 years, and it's had that for about 80 years. And so 80 years later, they're still mining a mine with sub 10-year reserve life. And our geologist just came back and said, there's exploration all over the place. If you drill below the current working zones, there's exploration upside. If you drill above the current working zones, there's exploration upside. If you drill to the side of the working zones, there's exploration upside. And so that's what we like to see. And it's those types of assets that we think get our investors in the long run above average rate of return. So we're pleased we were able to get this. It wasn't a huge deal. It was only a $30 million deal for us. But it's another one of the deals, and we just keep adding streams and royalties to our portfolio to diversify for shareholders, and we're pretty proud how this fits into that portfolio.
And you just mentioned that one of your geologists went to site. Maybe why don't we just talk about that and talk about your due diligence process and also your in-house technical team. How many people actually went to site?
Yeah, we actually had a number of people go to site, including a number of geologists, and it was an interesting due diligence site visit, trying to get people from the U.S. and from Canada all to Fiji during COVID. It was interesting, especially since there were no flights allowed in or out of the country, at least commercial flights. So we ended up having to get private planes and put people into military quarantines, and then when their quarantines were over, there were countrywide military lockdowns because of COVID spread, and then one of our guys got dengue fever, and getting him home was trouble too. So I think for a 5-day site visit, they ended up spending over a month in Fiji in various types of lockdowns. And but at Sandstorm, part of the reason that we exist and part of the reason that we have a business model is because we're able to act fast when people need capital, and we're willing to do whatever it takes to negotiate the transaction as quickly as possible and get due diligence as quickly as possible. When you do a deal with Sandstorm, it's not like doing a bank that sits there and hums and haws and takes 8 months to do due diligence. And we're there. We're smart mining people. We're willing to act fast, and that got us this deal. And I think our shareholders will make a lot of money as a result.
And Nolan, when you send a team of workers or co-workers to Fiji, for example, to do due diligence, what exactly are they looking for? What is it they're trying to find out?
Yeah, so the key to our business is understanding the risk-reward equation. So you're looking for risks and you're looking for upside. And upside typically is exploration upside. Sometimes it's production upside, so people that are able to expand mills and increase daily throughputs, that is a form of upside because the cash flow comes earlier than you thought and your rate of return is higher. So they're really looking on the upside for, does this asset have high probability exploration upside? And in this particular case, like I mentioned, it's been going 80 years. And so there's an enormous amount of exploration upside. So it ticked all of the upside boxes for us. And then in due diligence, what you're looking for is what are the downside risks? What is the metallurgical risk? Metallurgical risk is a substantial risk in an asset that hasn't been developed yet. Fortunately, this asset has been operating for 80 years, and there's 80 years of metallurgical history to show that the metallurgy is not a risk here. It's very clean concentrate very clean ore. And so that type of risk is one we look at. We look at country and political risk. This asset, again, having operated for 80 years continuously, kind of ticked the political risk box. The politicians are behind it. They always have been for generations and generations. And then you're looking for underground mining risk. You're looking for geotechnical risk, any host of other risks. And so our teams go down there. They double check all the work, figure out all those risks, create a risk register for us, and then we come back and we create our upside case scenarios and our downside case scenarios and our evaluations. And so this one, although it's a little bit of a higher cost operation, so that would be the highest risk there, it's a high quality asset that's been operating for a long time with lots of exploration upside in a country that's backed the mine for generations. So it met our threshold for risk adjusted reward equations.
And what were the use of proceeds?
So that's an interesting one here. In this particular case, normally in an operating mine, the use of proceeds is actually to go buy another mine or pay off debt or those types of things. Here, the use of proceeds is entirely to be invested in the mine. So they're going to be doing drilling. They're going to be expanding their mill so that they can increase the throughput that goes through the mill daily. And they're going to be doing some work on expanding tailings and those types of things. And so we haven't actually even given them the $30 million yet. We give them the $30 million over time as they complete objectives in that capital expenditure set of investments that they're going to make. So we'll be giving them the $30 million here likely over the next 6 months.
And I bet it was pretty easy to get people to go to Fiji to do that site visit.
Yeah, no one was saying, no, don't send me there. Having said that, it wasn't the most enjoyable trip for them.
So the other royalty agreement was with Vale, and it was a series or a package of royalties, significantly larger at $108 million. So why don't you give us an overview of that?
Yeah, so Vale and their iron ore operations in Brazil are, basically as good as it gets in the world. They're some of the biggest operations in the world. These assets operate in the lowest cost quartile of iron ore projects in the world. They're going to operate for multiple generations, very long life assets. They tick all of the boxes of everything we're looking for, except they're not precious metals. We would have been a lot more excited if there was more gold. So these royalties, for people who aren't familiar, are on a series of mines that include iron ore, that include copper, and include gold. And so there's a little bit of gold in there, but the bulk of it is iron ore. I think one of the reasons we liked it, other than the fact that it's a long life, low cost mine, is that we're constantly looking for scenarios where we can where we think the market has gotten something wrong. And so in this particular case, these assets are effectively priced as if the long-term iron ore price is going to be $65 a ton. And I'm a big believer that the governments of the world have been printing money and devaluing currency, and that we're going to go into a large economic expansion here over the next number of years, also in an inflationary environment. And so you're going to have things like iron ore and steel prices be at above average prices, and those prices will be inflating because currencies are devaluing. So right now the iron ore price is closer to $220 US a ton, as opposed to the $65 a ton that these things were sort of priced at. And so do I think the iron ore price is going to stay at $220 a ton long term? No, I don't, but I think it won't be 65. I'd be willing to bet it's closer to 100 to 120. And I think the rate of return we're going to get for shareholders is very, very high on very, very low risk assets. So we are a precious metal streaming and royalty company. But if you fast forward to kind of 2024, 2025, once our Hod Maden asset is up and running, I would expect that will be 85% of our production will be from gold and silver. And so this very much fits into what we've told our investors for a long period of time, which is we are willing to invest in other commodities as long as it's hard rock mining and as long as those other commodities never get above 20% of our total revenue.
And just to be clear, this is on not just one producing mine, but a series of producing mines.
Exactly. It's a series of producing mines, and there's some mines that come off in certain years, and then new mines that come on over periods of time. But let's call it, say, 6 producing mines at the moment.
And who were the owner of these royalties?
So they are predominantly institutions in Brazil. So these royalties were created years ago when Vale was privatized, and they've been held by institutions in Brazil for a long period of time, and so we bought them off them.
And so the iron ore is going to represent what % of your revenues, ballpark?
Oh, it'll be well under 10%, probably, depending. The answer is it depends on the iron ore price, but if I'm right about the iron ore price, it'd probably be around 8% or something like that.
And did you also send a team, a technical team to Brazil to check out these assets?
So in this particular case, we didn't need to for a couple of reasons. One is that our team has actually been on site to some of these large iron ore assets in Brazil. So we had a good understanding for what they looked like and how they operated. And then the other reason is not only is it multiple assets, but they're virtually all in production, all operating at the lowest cost, in the lowest cost quartile of the entire worldwide cost curve. So these are some of the largest and best and lowest cost assets in the entire world with a long history of such. So we didn't need to go back again.
Nolan, that's a great update on your recent acquisitions. Why don't we move on to the development side of your portfolio, beginning with Mara, and why don't you provide us an update on that?
Yeah, I think one of the things that Sandstorm doesn't really get enough credit for is the sheer number of development assets that we have in our portfolio. We really just get valued based on our cash flowing assets. If you take the assets that are cash flowing right now and figure out what a reasonable enterprise value to EBITDA multiple is, we're trading at that number, assuming that none of the other assets ever turn on. And we have a number of assets in the development pipeline. Mara is one of them. Mara is actually a unique one in the sense that we own a small royalty on it right now, but when we actually did that deal back in 2015, we had the foresight to negotiate an option to hand them back the royalty and make an additional payment of about $240 million US to get a 20% gold stream on the asset. So when we negotiated that, the gold price was about $1,200 an ounce. And we negotiated that $240 million purchase price, assuming $1,400 an ounce gold. But we sit here at gold over $1,800 an ounce and rising, and I think a couple of years from now, if I'm right, it'll be over $2,000 an ounce. But that purchase price for that stream is fixed at $240 million. So as the gold price keeps going up and up and up, our option to buy a gold stream just gets further and further in the money. And so even though that asset's in Argentina, and some people are worried about Argentinian government risk and specifically currency controls that would eat away at profits, we also had the foresight to structure the transaction offshore. So we're not subject to Argentinian currency controls or Argentinian taxation. We're just subject to Canadian taxes and US dollar Canadian currency issues, which is not a risk. So we think this is an option that has a huge amount of value for us. And we think that assets is being pushed forward a lot faster than people think it is. So it's a lot of optionality value built into Sandstorm. And we have a number of other development assets that are coming online that we're not getting credit for. So I think shareholders of Sandstorm who are patient and just sit there, that a combination of these development assets coming online and exploration upside just will keep making them more and more money.
And you just mentioned that you do have a portfolio of 229 different royalties, 29 are producing. How many of the 200 would be developers?
Yeah, that's a great question. I'd have to count it, but I would guess probably close to 50 are at the development stage. So we have only 29 in production, and even more than that is at the development stage. So we've got a huge portion of our portfolio invested in things that we think will be built over the next decade. And so when people look at a royalty company and try to evaluate how long-term and sustainable are their current cash flows, well, for us, our current cash flows are not just sustainable without any future investments. If we never invest another dollar, our cash flow is just going to keep going up and up and up because of investments that we've made in the past.
And another development project you have in your portfolio is Hugo North. Why don't you touch on that? Which is, by the way, owned by Turquoise Hill, and it's in Mongolia.
Yeah, so that's an interesting one. It's one of the first mines I ever went to when they were first discovering it. I think I was there back in want to say 2003 or 2004. And it's an incredible asset. I mean, that asset alone accounts for about 30% of the GDP of the country of Mongolia. And the Turquoise Hill project is a world-class one. And the majority of the ore in the long term is on an area of ground where there's a joint venture between Turquoise Hill and a Vancouver-based company called Entree Resources. And so we did a gold and copper stream with that company, Entree Resources, a number of years ago. So Rio Tinto is the company that's actually mining the mine on Turquoise Hill's ground. Rio Tinto owns half of Turquoise Hill. And so when Rio Tinto gets onto mining this ground that Entree has their joint venture on, which we think it'll happen in probably 2027, 2028, so coming up here in a few years, that's when Sandstorm, we negotiated a stream on some of the gold and some of the copper that Entree Resources will have to pay to Sandstorm. And then Entree Resources themselves is an interesting case because they've got a fully carried joint venture interest in that project of 20% of it. And so they should be cash flowing $150 million a year once the mining is happening on that ground. And what most people don't realize is we actually own 25% of Entree. So 25% of that cash flow will just accrue to Sandstorm. So between the stream and between our 25% interest in Entree, you know, that easily could be $40 million a year of incremental cash flow to Sandstorm.
Do you own a lot of publicly traded companies?
Not particularly. We do have a portfolio of either loans that we've made to some of our partners or equity that we bought in those partners on the day we did the deal. So it's not abnormal for us to buy a gold stream on a company and buy a little bit of their equity at the same time. And then usually slowly over time, we sell that equity. And so we've got a portfolio that I haven't looked at in the last couple of days, but it's probably worth about $60 million of debt and equity investments in other mining companies.
So are there any other development projects in your portfolio you would like to highlight?
Well, there's a number. I could go on and on and on, but we've got things like Global Marte, which Kinross is going to be developing. We've got things like Hackett River. If it ever moves forward, it's a Glencore asset that we've got a royalty there that would cash flow $10 to $12 million a year to Sandstorm. We've got a number of other smaller assets, and yeah, the list goes on and on.
And Nolan, is there one asset in your portfolio, let's just say a producer that's being very aggressive with exploration that you're very bullish on?
Well, that's a good question. There's lots that are being aggressive at exploration. Lundin Gold in Ecuador, they've got a project that they're starting to really drill aggressively, and our geologists think that there's a huge amount of exploration upside there. So I think shareholders of Sandstorm will be happy, but so will shareholders of Lundin Gold as they prove out that drilling. But one of the things that we do, which is actually the most labor-intensive slide in our corporate presentation, if anyone wants to go to our corporate presentation, what we've done is we've graphed the meters drilled on every single project that we have a stream of royalty on by every single one of our partners for every single year since Sandstorm was created. And so you can see how many meters are being drilled by our partners on our projects year by year by year. And so last year we were running about 500,000 meters drilled on our projects by our partners, which Sandstorm doesn't have to pay for. They've put all that money into drilling. And so I think we're running 5 years in a row now where our partners have found more ounces of gold attributable to Sandstorm than they've mined, which is fantastic if you're a Sandstorm Gold shareholder, because what it means is every year we've gotten all the cash flow from all the operating streams and royalties, and at the end of the year we had more reserves and resources sitting in the ground than we did at the beginning of the year, even if you exclude any of our acquisitions. So Sandstorm's just been a cash flow generating machine for a number of years. The exploration upside just keeps replacing that.
Nolan, I just want to ask you one question on capital allocation. You and your team have done a great job of buying back stock when the stock was cheap on a price to NAV basis. How do you determine when you're going to allocate funds toward a buyback or toward the purchase of a stream or royalty?
Yeah, so we basically look at what streams and royalties are out there to buy, and we're always evaluating those relative to the alternative, which is we can buy a portfolio of stream and royalties in the form of Sandstorm shares. And there are some times where making the next acquisition made sense, like purchasing this deal on Vatukoula and the royalties on Valet. And there are times where we go, you know what, the cheapest thing we could possibly buy is more Sandstorm shares and buying into our own royalty portfolio. So as you said, we have done that at times. I think we bought over 16 million of our own shares over the last few years, which is probably got to be in the top 5 of all mining companies in the world in terms of share buybacks. Like, we really do put our money where our mouth is and believe in our own story. And so we're always weighing those two things, buy our own shares versus buying more streams and royalties off against each other. What I will say, though, in terms of capital allocation, the one thing that I do think that's going to change going forward for Sandstorm is I think we're imminently on the precipice of becoming a dividend-paying company. I've been talking with our board at length, and although no final decisions have been made, I'd be very surprised if in 2022 we didn't pay a dividend.
Nolan, one of the great things about the whole royalty model is the upside you get from the exploration work that's done by a producer, and which extends the mine life, and that means more cash flow to the royalty company or the royalty holder. And what's been the most profitable royalty or stream that Sandstorm owns that's generated the most cash flow over the years and the highest rate of return?
Yeah, highest rate of return is hard to determine because we bought some royalties for, like the Hod Maden royalty, for example, that we own. I think we paid something like $4 million for that, and I think it's going to cash flow $7 million a year every year for the life of the mine. So the IRR for that is just absolutely through the roof. But in terms of some of the larger deals, I would say even it's one of the great things about the streaming and royalty industry is that deals typically, as they age, just start looking better and better and better. So the very first deals that we ever did 10, 11 years ago when we started the company, they're the ones that the exploration upside has been able to show how much money we've made and how high the IRRs are. So I think, we did a deal on the Arizona mine in Brazil, which is now owned by Equinox. That's one of the first deals we did. I think we invested something like $50 million in total there. And you fast forward 10 years, we've already got $100 million back, and we're cash flowing $7 to $10 million a year, and there's still a very, very long life of the mine back. So, we're going to triple, quadruple, or more our money, and that's pretty high IRR. Same thing with Silvercrest, and they had an asset called Santa Elena, which is now owned by First Majestic, and we did that 11 years ago. And if memory serves me correct, we at first gave them about $12 million. You fast forward 11 years later, and we're still getting, about that in terms of annual cash flow from the asset. And we're getting it every year. So we're getting our capital paid back every single year here. And there's still a number of years left in the mine life. So the longer a stream of royalty is out there, usually the smarter and smarter management looks and the better the deals look. And so, we've done a number of deals that have made us a lot of money, but I think a lot of the deals that we've made over the years, just give them time and they'll look pretty smart.
And as we wrap up here, Nolan, what can investors expect in terms of news flow in terms of the back half of the year?
Yeah, so in the back half of the year, it is actually going to be pretty catalyst rich, I believe, for us. There's always your normal things like exploration and upside, but we have that every year, and that's always good news. We've got a number of our development assets that are going to be moving forward, probably the most significant one of which is Hod Maden. That's a big piece of our growth going forward. It's an asset in Turkey. I think right now the market is not pricing it into our stock and assuming that the asset never gets permitted and never moves forward and never gets built. And we admittedly, they are a little bit late in getting their EIA from original guidance, but I think the catalyst that you're going to see this year as related to that asset, I think there's going to be an EIA granted by the government. I think there's going to be a feasibility study put out by Sandstorm. I think they are going to start construction of their long lead items, including a road. I think they're going to award the EPCM contract, and I think all of that is going to happen in the last half of this year. And so I think that'll be a major catalyst for Sandstorm stock prices if all of those things happen. And I do believe they all will happen this year.
Well, Nolan, that was a great update on Sandstorm and also your recent additions. I especially enjoyed that discussion on the due diligence process and what it involves. If any of our viewers have any further questions for Nolan or his team, please send us an email to info@bloorstreetcapital.com and we'll make sure you get a response. Or if you would like some research on Sandstorm, send us an email and we'll send it along. I would also encourage you to check out the Sandstorm Gold website. They have some great videos on there, educational videos on what a royalty is and how they can benefit your investment portfolio. And with that, once again, Nolan, thank you.
Well, thanks for having me again.
Peter, thank you for joining us today. It's good to see you again.
Good to see you, Jimmy.
Peter, the Sprott name is synonymous with gold and silver. So before we dive into your various divisions, why don't we just start with a brief overview of Sprott and a brief history of the company?
Sure. Eric started the company in 1981, so we're one of the longest standing investors in the sector. We originally built up as a private client asset manager, and the company was converted to a full fund company in 2000. And we built aggressively all through the 2000s to be who we are today.
And you took over in 2010. Maybe you can just touch on how the company has really evolved since that time.
Sure. It's continued to broaden our scope across the sector. So we introduced lending, we introduced private strategies, we introduced some more physical trusts. We just continue to get more global and cover mining in more ways.
And Peter, what are the various divisions at Sprott Inc. and what's the AUM of each division?
Well, the largest is exchange listed products, and we had at last reporting date about 12.2 billion in that division. We have a managed equities division, which is your public equities, your public equity funds, and that's about 2.5 billion. And we have private strategies, which are mostly funded by institutions, and that would be, depending on how you count them, somewhere between 1 and 2 billion. And then we have brokerage, which also has some private client assets, and it has about 1 billion of managed assets in that section.
Peter, you have a physical trust product for gold, silver, platinum, and palladium, and you just announced a new one recently for uranium. Why don't you give us an overview of that new product?
Sure. I think the acquisition of the management contract for uranium participation, or UPC, is a really important move for Sprott, and we're really happy to have made it. We've been a long-time investor in the uranium sector, specifically between 2000 and 2007. I think that uranium went through a very tough time and is now poised for bull market conditions. We think it's part of the green energy solution. So it's great to be taking over this vehicle and modernizing it going forward. So we have big plans for UPC. Part of that is to use our skills as an asset manager to market the uranium trust more aggressively. Part of it is a change in the structure of the product. What used to be a company is now converted to a trust. What that will do is it will allow us to assess and look at the market at all times on a daily basis. So our investors will be looking at it on a daily basis. They will get a daily NAV, and we will be looking at it on a daily basis. We will be able to match buyers and sellers of uranium on a daily basis, where the company had only been doing that occasionally in the past. And I think that's going to make a huge difference. It's going to make for a larger and more liquid trust if we have our way. It's going to make for a more active trust in the marketplace, and hopefully providing greater transparency to investors in terms of setting a uranium price and quoting that price on a daily basis. So all of that together, we're really excited about. We are going to be making an application to the New York Stock Exchange. We do think the much larger pool of investors resides in the US for this sector. And we thought, similar to our other physical trusts, we needed to bridge that gap and take it to our principal audience, which are US investors.
And have you started buying uranium yet? And how often will you be purchasing it?
Well, as a matter of fact, we announced yesterday that we had made our first purchase on our first day, 100,000 pounds. And if that's any indication, I think you'll see that we'll be fairly active. So we look forward to reporting again on a daily basis as we build the trust.
Peter, another interesting component of this new product is the ATM feature. Maybe you can just touch on that.
Yeah, I touched on it briefly, but just in the daily market making, in order to make an efficient market in terms of raising capital, we believe that computer-generated automatic purchase program for investors is the most efficient way to go. So we run those ATMs on all our trusts, and what they do is they can issue units when the trust is trading at a premium to its underlying net asset value. And that can happen on fairly large scale. It happens under a shelf prospectus. So it's perfect for, we think, it's perfect for this product.
So as you mentioned, Peter, the physical trust business is the largest component of Sprott, representing approximately $12 billion of $17 billion in total assets. Can you just explain how this business works and how you make money on it?
Sure. It's pretty simple. Our motto, our promise to investors is to provide access and trust that they have full physical ownership of the metal. And so it started in delivering that premise, making it liquid on exchange so that there's always a bid and ask in the appropriate zone, and then also providing investors with a lot of information on the markets. So the metal's there, it's 100% physically backed. And what we do is we charge some expenses back to the investor and a small management fee for managing that physical commodity.
Peter, the Sprott business, it's not a royalty business per se, but it does share many of the same attributes or characteristics of a royalty company. Why don't you just touch on some of those characteristics?
Sure. Well, I agree with you, Jimmy. Our trusts are just that, physical. Our assets are sticky like royalties are. Our margins are high on those assets, much like the margins of royalty companies. And our revenues are denominated in the commodity prices themselves. So if commodity prices move up and down, we have leverage to that both ways. So at the end of the day, our results, our EBIT is very similar to that of a royalty company. It's high margin EBIT stemming from the management of commodities, in our case, mostly gold and silver. And I think our EBITs are similarly leveraged to the gold and silver business as royalty companies are.
And you also pay a dividend?
Yes, we do. We've made that a commitment to investors from the onset. We've never reduced our dividend. We've only increased it, and that's a commitment that we make going forward.
And one of the big benefits of a royalty company is the exploration upside. And am I right to assume that you have the same sort of exposure through your active management portfolio?
Yeah, we don't have quite the same exposure. As you say, royalty companies really do benefit strongly from exploration. What we have is we have managed equity portfolios and managed private asset portfolios, and we like to think that if we do well, we start to leverage those assets through similar returns, but we do so through the valuation of their equities or those projects.
And are there more flows going into the physical trust business or the active management business?
I think it's true across the globe that the funds have been more focused, the funds flow has been more focused on physical trusts. Investors seem to prefer that. It's a larger area, it's more liquid, it has less volatility. The dollars, the big dollars, have not really returned to the equities, although, you know, that's notwithstanding the performance in that sector. We like how we've performed in the last 2 or 3 years, and we like the valuations of those equities. So I think it's time that it happens, but we can't push on a rope, and it'll happen after the results continue to get posted.
But why do you think that is? 2020 was a very good year for precious metals and also for the equities. And these gold companies, gold producers, are cash flowing gobs and gobs of money. Why aren't the generalists coming back to that sector the way they did back in 2010, 2011?
I think the bar is a little bit higher than it was back then. So the bar for liquidity, the bar for generalists getting into a sector, it's still a fairly small sector. Totally agree that the results have never been better. The equities have never looked cheaper, and the whole sector is really healthy now. And I think it's just a matter of time before incoming capital starts to lift those valuations. So I think it's just taken some time to get investors comfortable again that this isn't just some volatile sector that's based on more hope, that actually the results are there now and they can confidently buy.
Peter, one of your divisions is the active managed division, and that's also comprising the Tocqueville acquisition that you did in 2020. How is that going overall? And are you happy with the growth in the AUM associated with that division?
Well, I think we're extremely happy with having acquired Tocqueville. It's a hand-in-glove fit. We really like the way that our portfolio managers interact now as a team globally. And we've launched a couple of new products that have been very successful in terms of performance. So I think the system is really proving itself. I can't tell you how proud I am of the talent that exists across the company now. I couldn't have imagined 10 years ago that so many of the great managers in the mining sector would all sit under one roof like this. So we get a lot of benefit talking to John and Doug Groh and understanding the sector better. I would say in terms of the assets, yes, we're reasonably happy with the way it's gone, but mostly from a performance perspective. To harken back to our last question, none of us are happy about not having quicker growth in the mining equities, especially considering that they're performing so well. So I think it's we're all hopeful that we get into a higher growth mode going forward, and I think the performance speaks for itself. So investors, I would forecast, are going to come to that sector over the next year.
So in February of this year, we had a big move in the silver price, and that was driven by Wall Street Bets, which is a Reddit community formed in January of 2021, and an extension of that group is the Wall Street Silver Group. Does this group have a big impact on your inflows into your physical trust business?
Yes, it has. I think they have importantly shone the spotlight on the importance of physical backing, and they've highlighted the sector as a whole as being one that has that similar characteristic to Bitcoin, in that it is a protection from fiat currency. So that flow from that group of investors was really important for us, and I think important for the whole sector, and profiling an asset that's physically scarce and that the commercial banks had been shorting. So it's helped our business and it's helped our trusts.
Peter, what % of your client base would be institutional as opposed to retail?
Historically, we've always had a strong retail client base across the sector. That's continued to increase in size, but institutions started to join the firm as clients probably 5 years back, and institutional money is becoming much more important to us now. The split, I'm guessing at this, but it's roughly 70-30 or 75-25 in that range. And the institutions are now, I think, a substantial source of new funds.
And given the move that we've seen in the price of gold and silver here in the past year, are you getting more interest from the institutional side of the business? Are you getting more calls from hedge funds, family offices, pension funds?
Yes. Endowments are probably the largest of institutional investors, and they're increasingly allocating to gold and precious metals and other metals as well as an inflation protection type of asset and a risk protection type of asset. So that endowment and pension money is really starting to show up. And as well, family offices have the same mentality. They have enough liquidity where they can put some money aside as an insurance asset, and they've been buying gold for the last 3 to 6 years, actually.
Peter, Sprott has acquired many companies over the last few years, the Central Gold Trust, the Central Fund of Canada, and also more recently Tocqueville. Are you going to continue on with this acquisition strategy?
Yes, we show no signs of slowing down. We will continue to look across the globe for products and teams that fit with our client base, and also where we see that there's money to be made, hopefully in a contrarian fashion. And if we find the right team or the right set of clients or the right product, we will definitely be looking at making more acquisitions.
In April of this year, Sprott acquired the royalty on the Red Mountain project from Seabridge for $18 million. Are you going to continue acquiring royalty and streaming agreements?
In our private institutional business, we have both project lending and we occasionally buy streams and royalties. So those, to be clear, those are managed funds, and we will continue to grow those businesses. So we will be out there looking for opportunistic purchases of streams. It's more associated with project financing for us than it is in competition with the royalty companies. So we like to think of ourselves as a good partner in that sector.
And Peter, where do you see Sprott going in 5 years? You currently have $17 billion in AUM. Where would you like to be in 5 years?
Well, we are really busy right now, and we're taking on new funds. We just landed the UPC acquisition, which is another $630 million. I see no signs of the slowing in that growth. I think that the sector has been underappreciated for a long time. There's lots of capital that needs to be invested, both at the corporate level, and I think as fiat currencies continue to remain a bit suspect due to rapid money supply growth, lots of different investors are hedging now and putting some money aside in these sectors. So that's just maybe in the third inning. It's pretty early days yet, and we've got a lot of growth to do over the next 5 years. So I see it going and growing into a much bigger company.
And how should investors look at Sprott Inc? Is it a asset manager, a precious metals company, or a royalty company?
It's a hybrid, to be clear. And I think they should look at it as a one-stop shop for the minerals and mining sector. We have less volatility than mining companies do because we have such a broad portfolio, and we have so many revenues and profits that come from low volatility management businesses. So it's a great way to participate in the sector as a whole. And as you mentioned, we pay a strong dividend. And I think if we could appeal to investors as a one-stop look into the sector, that's what we'd like to do.
Peter, that was a great overview of Sprott Inc. As we wrap up, what can investors expect in terms of news flow in the coming weeks and months?
Well, we have our quarter, which comes out at the beginning of August, and we'll update our AUMs and funds flows and financial performance. And I think that investors will be able to keep track of our uranium purchases as we report those publicly. Same thing goes for the managed trusts and the other sectors. And then we constantly have investments. We constantly have investment news coming out on our various funds and investments that we're making. So you can also follow us along through that news.
That's great. Well, Peter, I want to thank you for that overview. And to all of our viewers, if any of your questions were not asked, please send us an email to info@bloorstreetcapital.com, and we'll make sure Peter or another member of his team responds. Or if you would like some research on Sprott, send us an email and we'll send that along. I would also encourage you to check out the Sprott.com website. It has a wealth of information on there about gold, silver, and now the new uranium product. And with that, once again, Peter, thank you.
Thank you, Jimmy. Have a good day.
Hi, Hi, Shaun. Thank you for joining us today.
Hey, Jimmy. Thanks for the opportunity.
Shaun, Triple Flag is the newest of the royal companies, having gone public just recently on the Toronto Stock Exchange. However, the company's been around since 2016. So why don't we start there with a brief overview of the company, the history behind it, who were the founders, and what was the motivation for starting the company?
Yeah, time flies when you're having fun. And, we started it 5 years ago. I've always been in the mining space, operations and diversifieds like BHP Billiton and Extractor. And I actually left my role as CFO at Barrick to found this company with Elliott as a capital provider. And as you no doubt know, I mean, Paul Singer and the Elliott team are about some of the most sophisticated investors that are out there. They've been going for more than 40 years. Had incredible returns and a great track record, and the chance to partner with them and build a team from scratch with a model that I think is proven to truly deliver great returns if you can execute well, which I believe we have, was the enticement. So it's been 5 years. I think we've built an incredible team and portfolio, and Elliott has been a great partner, and that's allowed us to get the scale, quality, and critical mass to IPO recently.
And so I'm curious, I know you can't speak for Paul Singer and his team, but if they went ahead and started this company with you, they must be very bullish on gold.
I think it's well documented that they like precious metals and gold in particular. When they looked at the space, I think they found that the royalty and streaming model was really probably the most compelling way because of the asymmetry that it offers for participation in life extension, exposure to the price cycles, without a lot of the, let's say, negatives you often see at times with equities and elsewhere, where you can see cost inflation, closure liability exposure and things of that nature. So the chance to get exposure to ounces and participate in future life extension, exploration success, maybe expansion, and while getting a dividend is really what drew them to this.
That's a great overview of the formation of the company. And let's talk about the IPO. You just IPO'd in May of this year. Mm-hmm. And let's talk about who the lead underwriters were and how the demand was.
We had a great syndicate. We listed in the Toronto Stock Exchange, and we had as active book runners Bank of America, Credit Suisse, and Scotiabank. And they did a really good job for us. Now, demand, you never really know. We haven't seen a lot of empirical data, obviously, for large IPOs in the mining space in recent years. I think we are, the largest, mining IPO since 2008 or 2009, and certainly the largest precious company for a long time that's, listed in this space. We found very good demand all over, and I think possibly enabled also through this virtual format. We didn't have to get on and off aircraft, which was quite nice. So we saw very strong demand in Canada, certainly in the United States, Europe, and the rest of the world. We've got a good mix of specialists, generalists that came into that, as well as sovereign wealth funds and pension funds. So we were really pleased. I think you could describe it as a strong blue chip register, which we were very, very happy to get. We were about 3 times oversubscribed and had a very good conversion with our one-on-ones.
That's great. So let's move on to your selection criteria and your selection process. I want to get a better sense of how Triple Flag identifies royalties and streams. So maybe we can just touch on that and just touch on your deal size. Do you have a preference for jurisdiction, also a preference for the metals makeup of the portfolio?
Yeah, I think setting out, we did a lot of work to understand how to look at the space. And how would you characterize a streaming and royalty business that's high quality, and if you can execute well, will attract a good valuation with time? And I'd say those characteristics would summarize. You firstly need the ability to attract high quality deal flow and execute good deals, obviously. And then the portfolio itself, ideally you want long portfolio duration so you can get exposure to multiple price cycles. You want to be resident in good jurisdictions, typically the Americas, Australia, places like that, because these are long-dated contracts. You want exposure to the lower half of the cost curve, so these things are robust through the cycle. You want to ensure that you have high margins with the way that you structure these, and exposure with large land packages that are prospective. And if you fast forward, that's really what we've achieved. And this team, I'm very proud of them, what we've done. We've generated the most growth really in the sector in the last 4 years. It's about a 24% ounce CAGR. We've really focused most of our portfolio in Australia and in the Americas, so great jurisdictionally, more than 80% in the lower half of the cost curve. And that portfolio duration is over 20 years. There's only the two sector leaders that have comparable portfolio lives. It's almost double what you would see elsewhere in the sector. And that's before you see the sort of life extension and a very large land package that we have in this. I mean, our reserves and resources constitutes about, I think it's about 85 square kilometers, and our overall land package is nearly 9,000 square kilometers. So those things have been put together very, very carefully, and we've avoided investing in a lot of equities, which have a different risk characteristic and therefore would attract a different multiple. So I think the team's been super disciplined and has really created something that stacks up very well with the majors in the sector. And we have shown through our deal flow that we can compete with the largest in the sector for quality opportunities. We've done 16 deals for 75 assets, 15 are producing, and we've done 3 of the top 10 largest precious metal streaming deals that the space has seen in 5 years.
And since Triple Flag was formed in 2016, how many deals do you think you've looked at since that time?
We've kissed a lot of frogs. It's been well over 500 transactions now for the 16 that we've done. And I think an important characteristic with that is, we're a precious metals company. We don't invest in, fossil fuels, for example. We've got limited scope to do typically more like copper, nickel, assets like that we've got some exposure to. But we see that as maybe 10% of the portfolio. So I think we've really been very focused on maintaining that, and we've seen a lot in that 500 plus set of opportunities, and we continue to be very active.
And what about deal size? What's your sweet spot when you're looking at a royalty or stream?
We saw the opportunity here. If you bifurcate the space, you'll see a lot of smaller new entrants that have come in this sector. And they are typically buying, smaller, maybe portfolios of royalties, which we see, but we don't always find a lot of fundamental value there. We really saw the opportunity set as the ability to compete with the 3 big guys, which requires the ability to write the checks. And to your question, we saw a lot of opportunity in that $1 to $500 million sort of check size range. We look at a lot that are bigger. We see some that are smaller. Our largest was North Parkes for $550 million. But, in that area, the competition is sophisticated, but it's not overrun. And there's a know-how component there, which really we've got in our team. And we've brought as being on the mining side prior to this, having worked on streams and royalties and things like at Barrick Pablo Viejo and the Cobre de Panama transaction with my partner, Sheldon Vanderbilt.
That's great. So let's move on to your portfolio now. As you mentioned, you have 75 assets, 15 of those are cash flowing, 5 of those are ramping, all at various stages. And we don't have time to focus on all of them, but I want to pick out at least 3 or 4 of them here. As you mentioned, North Parkes is your largest. You paid over $500 million for that, and located in Australia, and it's owned by China Moly. Why don't you provide some background on that asset and how it's beneficial to Triple Flag?
So that is, in our 5 years, it's the single best asset that we've encountered. It's a former Rio Tinto asset that China Moly acquired a number of years ago. It's a copper mine actually in New South Wales, a few hours outside of Sydney. And this is a copper porphyry. It's been in operation for over 26 years. There's more than 500 million tons of reserve and resource, and it has an enormous land package around it. So the surface manifestation for reserves, resources, tailings, surface facilities where they produce this very clean concentrate is really 26 square kilometers, and the exploration land package that surrounds it, that we're exposed to, is over 1,000 square kilometers. We're incredibly excited about it. They've got an expansion underway now where they're at 6.4 million tons going to 7.6 million tons, and that's going very, very well. And this is a mine that I think was the first fully automated underground mine in the world. It's highly sophisticated and efficient, and they have incredible ESG and community relations, which was a very important factor for us. So we invest actually $50,000 a year alongside them in their community initiatives and scholarships and that. And that's something we actively look for to support our mining partners. It's a beautiful asset for us.
Another significant stream in your portfolio is Cerro Lindo, which is owned by Nexa and located in Peru. You invested $250 million on this to purchase a silver stream in 2016. It's already returned $136 million in cash flow. Why don't we talk a little bit about this asset?
It's a great demonstration of the streaming and royalty model. This was our first deal, and as you said, it's actually over 140 million now of silver ounces. These guys run a highly capital efficient, low cost mine in just south of Lima, and this is all the water comes from desal. It's a mine that they've taken from 5,000 ton a day to in excess of 20 now, and they continue to add life. So we've got the same reserves now that we had over 4 years ago when we did the transaction, and it's got I think a 90 odd square kilometer land package that's very prospective. So it's exactly the sort of asset that this form of investment you'd love to have exposure to, and Nexa has been very good as a partner.
Another significant asset is RB Plats, which is in South Africa. Why don't you tell us a little bit about this gold stream?
Yeah, so it's a beautiful PGM mine. We surveyed that area and found that there were a couple here who had impeccable ESG credentials, great in working with their communities and that. And you'll see this mine is really the largest shareholder is the Royal Bafokeng. This is like their sovereign wealth fund, the perfect local partner on a mine in Stelldrift that is ramping, which is highly mechanized. It's a former Anglo-American joint venture and offers multi-decades worth of life. And our capital there help them replace high-cost debt. It generates very strong cash margins. And again, we've invested, $100,000 US a year in scholarship programs. We just graduated our first 4 engineers, and that'll go on for many years to come.
And another mine a lot of people will be familiar with is Buritica, which is located in Colombia. It used to be referred to as Continental Gold, but you have a silver stream on this asset. You paid $100 million for it, and it's already returned quite a bit of that. Can you touch on that, please?
Yeah, I will. We've got a little under 20 million of our original investment outstanding, and the mine is only ramping up now. This is a multi-million ounce reserve and resource, and I think we're as excited about just the underlying quality of this mine as we are about the prospectivity. I mean, the reserves and resources on this constitute less than 0.2% of the overall land package here, and it's open at depth. It's super high grade. And we think the optionality that this provides is extremely exciting.
And then one more producing asset that I want to touch on, and a lot of people are going to be familiar with Fosterville, which is owned by Kirkland Lake and located in Australia. The mine has achieved record production in 2020, 640,000 ounces, and Kirkland Lake has a very aggressive drilling program going on there. They're going to spend over $85 million this year. And once again, this is another great upside associated with royalties and streams, is that you as the royalty holder, you don't have to spend a penny on this exploration, but it can be very beneficial. So why don't we talk about this asset?
Kirkland has done an incredible job with their exploration activities over there. I think the Swan Zone is obviously very well understood. And when we made the investment, it was only at the beginning of the Swan Zone and the potential that represented. And since then, they've made all these additional discoveries. And as you say, they're investing, nearly $100 million in activity there this year alone. It's a sort of a deposit with a very large land package that we're exposed to with a royalty that, we look forward to, hopefully many more potential Swan Zones in the future. And I think with that sort of investment, and certainly with their history of these sorts of discoveries, we're really excited about that. You would have seen the Q2 results. Again, they significantly outperformed certainly our expectations, and I think many others. And I think it's the sort of asset that offers that kind of potential in the future.
Shaun, that's a great overview of your producers. Let's move on to the developers. And the one that really stands out to me is Tamarack, which is high-grade nickel and located in Minnesota, and it's owned by Talon Metals. And they've released some very positive drill results here in the last few months. Why don't we talk about this asset?
Yeah, Shaun and Henry have done, I think, an incredible job there. It feels like every other week I get an email from them or I see a press release where they've made more discoveries and extensions. I think they've only really explored like 0.8 kilometers on strike there, and I think there's like 16 kilometers. So, you know, the potential for them going forward is incredible, and we've just been so thrilled to have been able to support them with funding that they needed early on, and to see them get rewarded, and certainly ourselves through our royalty exposure there. So I think in the battery metals space, the asset that they've got and where it's located, I think it's just incredibly exciting, and I'm very proud of the success they've enjoyed. We've got a lot of other, you know, certainly on the precious metals and elsewhere within that, call it the 60 assets that are non-producing. Some of them are surprising. These are things that tick away. So, you know, you would have seen we've got Calibre Mining's Eastern Barossi project, where we're seeing, you know, some good drilling and good activities as part of their hub and spoke activity. We got a 2% royalty there. We're really excited about that. It's a recent acquisition. You know, the even small things that we picked up a while ago, like we got a royalty on Newfound Gold. You've seen some really, you know, impressive intersections and some good activity in that area. And then just even North Parks, I mentioned Cerro Lindo and others, that the potential of just future extension in these assets with a brownfield expansion, we think is super exciting. So it's the beauty of this model when you've got big land packages like that and companies spending money on exploration.
I didn't realize you had one with Newfound Gold, and it's amazing what's happened in that province of Newfoundland and how that mining industry has just exploded there in recent years.
It is, and we acquired that as part of an investment, strategic investment in Goldspot, who have an incredible geosciences and machine learning capability, and that was one of the royalties we picked up there. It's very impressive what they've done.
So that's a great overview of your portfolio. So how are things tracking this year? How's the pipeline looking? You mentioned earlier, since the inception of the company, you looked at over 500 deals. But what about 2021? How's the pipeline looking?
You know, if you look at our track record, you know, when you're starting off and you're hiring people, you're trying to get in the deal flow, there's always this question: how are you going to compete with these very successful, sophisticated, established companies? And you'll see through our 5 years now, we were out the gate very early on. We've been in mining forever, and our ability to source deals and then actually execute has been consistent. And we're as active now as we've ever been. The nature of the deal flow does vary through the cycle, of course. We've seen a lot of work on balance sheet repair. We are active on some of that, but there's less of that at this point of the cycle. I think there's more development stage opportunities and maybe some M&A, acquisition financing, and some non-core portfolio transactions. And these tend to ebb and flow, but we're about as active as we've ever been at this time.
Shaun, you're listed on the Toronto Stock Exchange, but you are not listed in the US yet. What are your plans for getting a New York listing, and what's the timeline associated with that?
Yeah, so, you know, we thought Toronto was the right place for us to list, and we're very happy with the outcome. The logical route for us is to go through JDS, and I think the window before we can do that is about a year from listing in Toronto, and we're likely to do that once our seasoning period is behind us.
So, Shaun, as we wrap up, what can investors expect in terms of news flow here in the second half of the year?
I think first cab off the rank is our first set of results in August, and we're very excited with the performance of the portfolio. Really, we understand as a team that has delivered a lot in the private realm, it's important we develop a track record now in the public realm. So that'll be the first bit of news flow that comes out. We'll be paying our first dividend, and you'll see we've got a sector-leading dividend at the IPO price of 1.5%. And we aim to look to continue and grow that, ideally progressively into the future. I think there's potential for catalysts of some of our partners in the portfolio through the second half of the year, and so we look forward to that. There's potential for index inclusion, early index inclusion for us, in Q4, and we're active on a lot of transactions. So you can never forecast these things, but keep an eye out. Hopefully, we'll have some more news on the transaction front in the months ahead. I think that should cover it.
That's great. And I got one more question for you before I let you go. I'm curious about the name Triple Flag. How did you come up with the name?
Yeah, exploring ideas with Elliot at the time. And it turns out my three children, as a miner, you live in all parts of the world. My three kids are born in 3 different countries, hence 3 flags, Triple Flag. Elliot liked it, we liked it, and it just reflects the sort of family nature of this team and the partnership that we've built together.
Oh, that's a great story. Well, listen, I want to thank you for introducing us to the Triple Flag story. To all of our viewers, if you have any further questions for the Triple Flag management team, send us an email to info@bloorstreetcapital.com and we'll make sure you get a response. If you would like some research on Triple Flag, send us an email and we'll send that along. Once again, Shaun, I want to thank you.
Jimmy, thanks so much. Yeah, appreciate it.
Well, that concludes our royalty conference, and I hope you found it informative. If we did not get a chance to ask your question during the conference due to time constraints, please send us an email to info@bloorstreetcapital.com and we'll make sure the appropriate company receives your question and you get a response. Once again, I want to thank you for taking the time today and thank you for your support.